All right, my friends, every now and again I'll do this from Vanguard. When will we get back to average market returns? Because I hear this all the time. It's way too volatile. It's way different than before. Oh my goodness, man. It's not. It's always like this. Always. So every year Vanguard gives us their study. When will we get back to average market returns? And every year it's the same thing. And I'll share it with you because it's so important for you to understand. This right now, whatever it is, I could care less when you're watching this. This could be in year 2100 for all I care. It's gonna be like this unless the communists take over, and then there will be no market returns. So everything will be average. Will be average poor, if not dead in the gulag. But anyway, so here's the issue with markets. Everyone says average returns are X, and we should be once I'll get back in the market, or I'll not worry so much once we're back to X. And the facts are we're never near X. We're way up here and way down there. So. Here's Vanguard. Average total returns in stock and bond markets are often cited in financial circles, perhaps giving lay investors the false impression that returns are the norm. In reality, there have been few years when either stocks or bonds delivered returns that are even close to the market averages. Financial markets, particularly stocks, are inherently volatile over the short term. To benefit from the long-term market performance, investors should temper their expectations and stay the course. So, this gives us a standard deviation. I don't see it. All right, but anyway, average annual returns going back to 1926 to 2018. The average annualized return, including dividend reinvested, is 10.09. I think we're using the S&P 500. Yeah, S&P 500. Basically, S&P 90 from March 26 to March 1957, and the S&P 500 since. So we'll just say it's the S&P 500. 10.09% are the average annual returns going back to 1926. So hear this. In only 6 of those 93 years did the markets give us within 8% or 12%. So 6 of those 93 years, we got 12 or we got 8 or anything in between. So 8 to 12, that's it. Because the average was 10. Only 6 of those 93 years do we get 8, 9, 10, 11, or 12, or some semblance of that. That's it, man. Tell me that's not crazy. Thus, the average might be 10, but the market on any given year gives us far away from the average. Here we go, the 1929, right here, 1930, 1931, 1932. All right, so here's the average, 10.9%. And look, right here we got near the average, 1957, 1967, 1978. 1995, I'm thinking, that's 90, 91, 92, 93. Yep, 94 didn't do anything. And that's it. So basically, since I've been in this business, we've never been anywhere near 19, it looks like 2003, 4. 2004 is about the closest, 2018, 17, 16, 15, 14. And even that's 12%. So we've only been within 12%, literally 10's the average, 8 and 12. 6 out of 93 times. I don't think it gives us a standard volatility, standard deviation. No, it doesn't. I'm going to say, let's just say the standard deviation is 15%. I don't have that means if you are averaging 10 on any 66% of the time, if you have a standard deviation, I guess I'll write it here. Oops, it's made a big old mess. Let me show you how this works with standard deviation. Pardon me while I spit on this, because I got to get that cleaned up. That's so disgusting, Josh. You're spitting on the channel. Oh, my goodness, disgusting. All right, so we're going to give you how this works here. Boink. There's 10. All right, so there's our bell curve. It has some serious drawing right there, right? 10. So we know within 66% of the time, we're going to say standard deviation is 15 for just simplicity. 25 and minus 5. All right, so 66% of the time we'll get between minus 5 and 25% according to a typical bell curve. This is the drawback about Monte Carlo analysis is it doesn't take into consideration the fat tails, but this is all we can use. What else are you going to use? I don't get it. So we're going to go to 95%. We're going to get, negative 20. And what's that, 40? 15? Yeah, 40. So 95% of the time, we're going to get between negative 20 and 45% on the positive side. All right, that's at a 15. So we have an average rate of return of 10, a standard deviation of 15. Then 99.3 or something like that, or 6, I think it's 99.6. We're going to get between negative 35 and 60. And that, I mean, that, look, man, that's so 3 standard deviations. 99.6% of the time, we're going to get between negative 35% and 60% on the positive. That's pretty doggone close when you think about it. I mean, 2008, we're down 37%, and we had a 55% year a couple times. Like, I forgot, but anyway, that's pretty doggone close. So, I mean, 2008 was the worst. But that's worse. No, not when you factor inflation. But anyway, either way, so 93 years, roughly 100 years, we've had 2 or 3 times where we're, I guess 2 times that we're above the 3 standard deviation rule. And I'm just thinking 15%, it might be a little bit higher. That's pretty doggone close to what the bell curve, the Gaussian bell curve would tell you. So I'm pretty comfortable with that using Monte Carlo. I get it. It's not perfect, but it's pretty doggone close to about as best as you can get, especially when you use your realistic market returns plus Monte Carlo. When you use the historical market returns plus Monte Carlos, that gives you a pretty good gauge of what you can hang your hat on. Even though I did that video on Jim Otter talking about the Monte Carlo analysis, at the end of the day, the gist of that was junk in, junk out. That's all there is to it. So you just got to be careful what you're putting in. But even bonds. I mean, look, here are the bonds. Bonds have averaged 5.29% going back to 1926, and in less than 1 out of every 3 years did the bonds actually give you 5.29%, between 2 percentage points of 5.29. So 3.29 to 7.29, only 1 out of every 3 years the bonds give you that. I find that's the U.S. high-grade corporate bond index. I just think that's nuts. I'll put a link in the show notes. You're never, well, wait till we get back to normal. It's never normal. I mean, literally, the normal is not normal. There's no other way to say that. The 10% of average is not a normal return. 8% is not a normal return. 12% is not a normal return. Anything can happen. So just keep that in mind. One of my favorite charts out there. All right, we'll see you next time. Subscribe, hit the bell notification, and comment down below. Thanks now.